Hey there. So I recently came across this article which is called Life is Poker Not Chess. This actually was something that is blowing up on LinkedIn quite a bit. And I just couldn't help but get myself to actually go ahead and read this over this weekend. Um, this article was written by Robin Guo. I found this off Substack. Um, Essentially, what he starts out by talking about is he gives a personal anecdote. So he's talking about how 4 years ago he actually walked away from McKinsey. He had about a 300,000 private equity offer as well, and he went to work in gaming for a third of the salary. He moved across the country, which was from New York to LA, left behind friends and family. Um, and then he basically summarizes that this is what he thinks is going all in, and essentially the rest of the article sort of also flows from this basic anecdote, and he sort of used other examples and life experiences that he's had, but the core of those is essentially this summary. So just going on, he then goes on to say that he does contrast between chess and poker. So he's actually saying that in chess, the correct move is correct regardless of the outcome. In poker, you can play perfectly and still lose, or play like an absolute donkey and stack everyone at the table. And I think this is really profound because if you really do think about a lot of the way that life plays out, essentially, we do think it's more like chess with deterministic outcomes, but what we end up with is something like poker, which is a lot about probabilistic outcomes as compared to being more deterministic in nature. Um, he then goes on to talk about you're literally betting on incomplete information, but the real value comes from applying poker thinking to life itself. And this, I think, is something that I have come across a lot of the other folks who talk about mental models. So whether that's something that comes out of Shane Parrish or even Novel for that matter, and do reference Novel below, they all talk about the same concept about using different mental models and frameworks and actually applying them to decision making in life every day. Going back, he then goes on to say chess assumes a controlled environment, perfect information, one opponent, predictable outcomes, which is how we think about life a lot. Life is much messier. Life is multiple players with hidden cards, changing rules, and luck that can absolutely demolish skill in any given hand. And I think this is where you, if you do think about um, skill, Will Smith has one example where he actually says that put me on a treadmill and I'll outrun the person next to me who has probably better luck than me. So I'll actually use skill to win in this case. But at the same time, you actually do see examples where there are constant folks who put in who have a lot of skill, but essentially they do not have the luck to back that skill, and then they essentially lose out. So an example of this is if you think about um, Ronald Wayne, probably who was one of the investors in Apple. He basically had the luck to get in there early, but he didn't have the skill or the persistence to actually stay put, to actually make any tangible benefit or outcome from that particular investment. Um, He then goes on to say, once you start seeing life through the poker lens, you realize most people are playing chess in a poker world. No wonder they're frustrated when the right moves don't pay off. And I think this is really profound because um, a lot of a lot of the decision making that we do in life is based on very deterministic outcomes. They're very binary in nature. If this happens, and they're also sequential in nature. So, for instance, if A happens, then B will happen, and so on, but essentially sometimes C might happen before A, or there might be other outcomes that could potentially happen. And it's really important that we take these sort of thinking behaviors and mental models and start applying them to our life. So there's a lot of interesting anecdotes which I hope to apply in my life as well. In in the next part of this particular article, Robin goes on to talk about how probability and process, and then he goes on to say that thinking in terms of probabilities rather than outcomes, which is also something that I've heard a lot from Noel, especially in some of his very interesting tweet storms that he actually put out early on. You can do everything right and still get crushed by variance. And this is the case with a lot of folks that you'll hear about on LinkedIn. They did their high school right, they did their college right, they eventually managed to get into a top business school as well, and then they still feel that they are still less successful than some of the folks who took completely untrodden paths and still managed to succeed. He also talks about how he stopped torturing himself over failed decisions that were actually correct. Um, and this was the biggest mental shift that he had to make in real life, because up until college you're basically playing chess. There's a fairly well-trodden path laid out where the route to victory is clear: study hard, get good grades, go to a target school, land the prestigious job. So in summary, he's just articulated it way better than I just did. um Checkmate, then what? And I think that's essentially where the point that I was also trying to make earlier comes in, which is you do all the right steps, but then at some point in time, all of those steps are can get you so far, but then you reach a stalemate or you reach a checkmate in this case, and then what is it that you do? So he goes on to then say that you actually stop playing results-oriented games. And he gives the example of I should have bought Bitcoin in 2013 and start playing process games, which is where he talks about what's my framework for evaluating asymmetric bets. You stop letting bad outcomes invalidate good decisions. Focus on the process by which you made each decision. The outcome is just one sample from a distribution of possibilities. Um, the reason that I find this is as a very relevant example is that I was actually in that same position. I actually had a bunch of school friends who actually were early into Bitcoin. They were making these bets. They were also benefiting from the upside. Um, I was not even able to figure out how to actually set up a wallet or how do I go about and purchase this. Um, when you're dealing with something as complex as the Indian tax system, you're wary of. You're going to have foreign currency exposure risk. You're going to have taxation risks from those investments. You cannot harvest your tax losses, and this is before all of the crypto regulation actually came in. So I was even more paranoid than. Uh, Back then than now, where there is actually some amount of clarity. And then in in parallel, what you what the author is actually sort of articulating for is he's saying that, what is the framework for other asymmetric bets? So maybe Bitcoin is hard to do, but then there are 20 other opportunities that do exist. That could be finding a job which can give you asymmetric upside, or it could range from finding a stock which is or a public equity which is already listed out, and you do see that there is an unfair advantage that you could benefit from. And I think that's also something that comes time and again in the book by Michael Lewis, which is essentially The Big Short, where he actually talks about how a lot of these folks um, made asymmetric bets on um, you know at that point in time betting against the market, and then they essentially benefited from that. So I think very, very valid points. He then goes on to talk about table selection. So in poker, you can be the sixth best player in the world, but if you're sitting with the top five, you're the sucker. There's an old saying, if you can't spot the fish at the table, you are the fish. Um, One of the things that I hear at work quite a bit is that there's different ways to think about life and work. So one of those is that you could be a small fish in a big pond, or you could be a big fish in a small pond. And I think this talks back to that point as well. The other thing that um, I do think that I've heard a lot about is that if you're the smartest person in the room, get out. But I also feel that listening to this particular and reading this particular quote, I feel that that might not always be the case. I think one of the other things that does come up in this section, which is about table selection, is that on one hand, surrounding yourself with the best people makes you better. On the other hand, sometimes you need to be realistic, which is actually what I was just talking about. You'll have to level up or find a different game. In the next section, he talks about bankroll and bet sizing. So in life, the reason that this is in yellow is also because I do feel that um, I read this and then I reread this and I felt that it's so important that it should actually be in a different color. In life, the bankroll isn't just your bank account, it's your time and energy, your reputation and career capital, your relationships and mental health. Um, and I think this is just so true. Like for up till I was 30, for instance, all I was thinking about was how do I maximize my bank account? And then over the past few years or past few months, I do realize that it's not just about maximizing the bank account, but there's other buckets in life that you actually have to go ahead and focus on. Um, Obviously, that comes with some amount of financial security or a financial net after which you can do this. So I'm not saying that this is a universal truth. I am saying that this universal truth starts applying to maybe almost everyone post 30, but obviously from 20 to 30, as you're sort of starting to build that uh, financial safety net, all of these other things will take a back seat. But then the moment 30 kicks in, you start realizing that there are all these other things that you might be missing out on. So better to focus on them sooner than later. Um, Another thing that he does talk about is know your tendencies and how they evolve over time. I think this is a great um, insight because this was something that my one of my tuition teachers actually used to say. He used to say that. Uh, no one knows you better than you yourself. So if you're saying that, you've done the the hard work and you've put in the hard work, then it should show in your results. But at the same time, if you actually gave into your tendencies and you actually copied particular paragraphs or answers, or you didn't actually put in the effort that you should have, then you should know that you should not be expecting an unprecedented result or having um, an outcome which is very different from the amount of effort that you've put in, which actually is very different from asymmetric bets. But at that point in time, all that I was focused on was the amount of input that you put in, the uh, that is the sort of output that you will get. And a lot of these tendencies then essentially start to replicate in terms of behavior over a period of time. So if you, for instance, if you slack when it comes to work as a student, you then that slack basically might also trans transport itself into your work life, for instance. It might not always happen because the motivators are different, but essentially there is always a possibility that you could do. Likewise, if you're in a relationship and you have a tendency to always fall for the wrong person, and that tendency has might not all it's something that is stuck with you. Uh, Maybe the relationships and the nature of the relationships changes, but you always end up falling for a partner who essentially displays those similar traits which are not aligning with your uh, overall expectations that you would expect out of a particular relationship. Another great highlight, which does come up, is your risk tolerance should scale with your various bankrolls, not stay fixed. The bet sizes you're making at 25 should not be the same as when you are 50. Now, this can be both ways, right? If you become risk averse at 50, obviously, you should not be going all in on crypto, as an example. Um, Whereas at 25, because you do have uh, almost like a runway, which for the next few years, where you could try different jobs, you could be making more money, you can actually make those crazy bets in crypto, so that you get benefits of those asymmetric bets. That being said, there's also a flip side to this. So, for instance, if let's say that at 25, if you're making a bet of, let's say, a $10,000 bet, and you're doing the same thing at 50, maybe it's not worth it because in the same way that at 25 you have a runway, at 50 that runway is starting to shorten. So what you do have is capital. As long as you have protected that capital and you have the ability to actually go ahead and make an make a safe bet which will pay you off, you should start risking a larger pool of capital in order to benefit from that larger capital that you or corpus that you have accumulated from possibly the ages of 25 to 50 in this particular case. In the next section, he talks about variance in time frame. In life, variance is asymmetric. The right job, right investment, or right relationship can return 1000x. This means you should actually seek more variance in life than in poker, not less. You want to maximize your exposure to positive black swans. If you haven't read The Black Swan by Talib, it's a great book which I've had the chance to actually go through. I've flipped through it. Um, Surprisingly, I haven't actually read it cover to cover, but whatever anecdotes that I have picked up from it just tell me that it's a great book. The reason that I've also not been able to read The Black Swan is because every time I start reading The Black Swan, there are different Black Swan events happening around me, which almost always force me to give it up at some point in time. So I've read it in pieces, but it's a great book, and I'll just recommend it to anyone um, who is interested in understanding those sort of events. Going back, you want to maximize your exposure to positive black swans, but only if you can survive long enough for the odds to play out. Here's an example. If you, for instance, make a bet in the public markets, you're on the opposite side of a trade. I think Keynes has this quote that, the markets can stay solvent longer than any individual can. Something to that effect. I do not recall the exact quote, but essentially you always want to make sure that if you're making these bets, that you're also able to survive long enough to for these odds to play out. The other thing is that let's say you're looking at compounding, right? If you start putting in corpuses into a fixed investment, which is let's say yielding a certain amount, and you take different time frames, the maximum growth over a 40-year period actually comes from the year of starting from year 30 all the way up to year 40. So that's what he does mean when you say black swan events. Now, for someone who's starting at, let's say, these investments at 30, uh, by the time you're 70, you actually cannot go. I mean, a lot of people are starting to have longer lifespans, and they're able to live post 70. But by the time you're 70, you've actually exhausted a lot of your physical abilities. You might not actually have the um, physical and the mental acumen to actually enjoy a lot of that wealth. So, what you also want to do is you want to make sure that these bets, firstly, they are not such long horizon bets, but at the same time, they also play out in a reasonable enough time frame for you to actually benefit from them. The last thing you want is actually making these bets and having sleepless nights, which is something that again is going to take a toll on your physical health. Uh, Pivots are totally fine and happen all the time, but each pivot means starting the compounding clock over. So I think this is again, so let's just go back to that earlier example of, you make an investment which is for a time period of 40 years, right? And then what you start doing is you actually do not wait for those investments to pay out. So what you're doing is maybe you're shifting, um, maybe there's a fund which gives you terrible returns in the first 5 years, but for the rest 35 years, it was going to give you a compounded annual growth rate of maybe 15%, right? It's an extreme example, but it's just hypothetical. But what you do is you pull out from The fifth year, and you go and find another fund which actually gives you great return for the first 5 years, but terrible returns for uh, the next 30 years that you need to be invested in. Now, what you've actually done is, firstly, you will need a longer time period to compound this particular investment, but at the same time, again, you have to start over, which is exactly what he's trying to say out here. Reads and ranges. Someone disappoints us once, we write them off forever. Someone helps us once, we trust them with everything. That's like putting someone on pocket aces because they raised pre-flop. I think that's self-explanatory. I won't spend a lot of time there. Read the range, not the exact hand. You'll never have perfect information, but you can narrow the possibilities with every action. This is something that a mentor actually kept saying to me. He was like, just focus on the things that you can control. As long as you're able to understand about 70 to 80% of the information available to you, especially in terms of consulting engagements, that's actually a good enough data point for you to actually make a call um, on specific outcomes or probabilities or possibilities depending upon the situation. All right, next section, imperfect information. The key is getting comfortable making high stakes decisions with 70% of the information rather than waiting for 95%. I think this is exactly what I was trying to talk about, because by the time you have 95%, the opportunity is gone. And I think this is true for a lot of things. I'm actually reading More Money Than God. Um, and there's actually a great example of Ken Griffin from Citadel, and he was actually going to acquire a company, look at it from a lens of a distressed acquisition. There were other banks that were involved. So JP Morgan was running Goldman, all of these others. But essentially, the amount of time that it would take for them to get that 95% of the information, that company would have become insolvent. So instead, Ken Griffin, what he does is he actually goes and makes a bet with 70% of the information he has, and he eventually ends up profiting by about $1 billion through that particular bet. So again, uh, you if you have like 70% of the information, uh, get comfortable with making those high stakes decisions. So that's something that I'm definitely going to be taking away from this particular article. Analysis paralysis is just another form of holding every hand. Yes, you never lose when you fold. You also never win. The players who succeed aren't the ones with perfect information. They are the ones who make better decisions with imperfect information. I think this is, again, it's quite self-explanatory, and I won't spend a lot of time explaining this, but when I do look back, I do feel that it could be anything. It could be the decision to get married to someone you love. It could be looking for another job or thinking whether that's the right company or not. It could be an internal transfer that you're looking at. It could be leaving your job to actually go and start up. It could be thinking about starting a YouTube channel. It could be anything and everything. It could be moving back home from a foreign land because it's just time. You feel that you've made your money and you actually want to go back and stay with your parents and spend the last few years that they have in their life with them, and essentially, um if you don't, you could be in a perpetual state of thinking and gathering all the facts and thinking about the outcomes, or you could actually make a decision. So if you don't make a decision, nothing's going to happen, nothing's going to move. You're going to be exactly where you were yesterday, today, and tomorrow. It's only when you actually think about these things, get comfortable with about 70% of the facts that you have, and then take a bold call that you will actually be able to benefit. He then goes on to talk about once I have enough information to make a decision that's 70% likely to be right, I pull the trigger or fold. Waiting longer is just anxiety management, not risk management. And I think, again, people who make decisions quicker, more thoughtfully, using these frameworks, obviously, with potentially 70% of the information, obviously have a better opportunity to take those asymmetric bets, but then it also allows them to get on with life, get exposed to more opportunities, and hopefully benefit from some of these bets that come along their way. Bluffing. So in this particular section, he's talking about the threat of the bluff is often more powerful than the bluff itself. Um, I think we've heard this time and again. If people know you never bluff, they'll run you over. If they know you always bluff, then they'll call you down light. The optimal strategy is to bluff just enough that they have to respect it. He then goes on to say, sometimes it's better to let people wonder about your capabilities rather than proving them. Sometimes you need to project strength when weak, interviewing while unemployed. Sometimes weakness when strong, negotiating when you have leverage but want a long-term relationship. And moving to the next one, he talks about position and timing. In poker, acting last is a massive advantage. You see everyone else's moves before making yours. Position is so powerful that professionals will play mediocre hands in position and fold premium hands out of position. Sometimes there's a first mover advantage, but often the real edge comes from moving last. I think I agree to this because I mean, I have seen this play out constantly. It could be a crypto cycle where you have a lot of people who are getting in super early. They sort of benefit from that initial bull run um, as as that particular hype cycle sort of starts dying down. You see a lot of people starting to get out, starting to think that the cycle's coming to an end. Almost at that particular bottom, which is also potentially the end of that hype cycle, you'll see a lot of people get in at that point in time. What then happens is that they are able to ride the wave to the next hype cycle. They're going to make a lot more money, which is sort of in line with uh, what is being said here. Now, how does this differ from those folks who got in super early and the ones who had the first mover advantage? I think when the first movers are betting, they are taking very asymmetric bets because they are betting on something which is a proof of concept. It's not been tried, it's not been strategized. Whereas someone who's actually betting at that second point, which is when that hype cycle is sort of died out in the first, um, you know, after it's sort of peaked, what's happening is that these folks have an ability to actually go out and test the uh, strategies, the sustainability of that particular investment, how it's played out, um, how idiot proof is the investment as compared to those very early advantages. And that's why they're actually going in because they do realize that there is going to be an upside. It's just that at this particular point in time, the value at which this particular commodity or security is trading at is at a steep discount. And it's only a matter of time before everyone in the market realizes that there is significant opportunity that exists and it starts to peak back to its earlier glory or even higher. Sometimes you want to lead out and define the game. Sometimes you want to check and see what develops. The power is in choosing. Let others reveal information, make mistakes, show their dangers, then make your move. And I think this is again something that comes up time and again in some of the books that I've read. More recently, if you read Never Split the Difference, that's something that again is spoken about, and it talks about how you can uh, be in a position of power and use that advantage to actually come out on top. In the second last section of this particular article, um, we we see something around tilt and emotional control. So some of your best decisions will come right after your worst beats. And He then goes on to say, can you maintain process focused thinking when you're down 50% of your bankroll, when you just got fired, when a relationship implodes? Most people can't. They revenge trade, rebound date, panic, accept the next offer that comes along. And he then cites Marcus Aurelius. If you haven't read Meditations, I think it's one of the most profound books that I have come across. I've probably not read it in a while. I'm going to read it just because I see it right here. And I continue to see it on my Instagram recommendations as well. The best players know when they're not playing their A game. And I think from this particular section, if there's two or three takeaways, I think one of them is that if you have a mental model in place, it's only as good as your ability to use it in times which actually test you the most, which is after your worst beats. How does your behavior and your mental capacity change when you're faced in these particular situations? And I think Marcus Aurelius's book Meditations is a great example because it's essentially written in the form of a diary, but what he's showing is the very human side of decision making, um, what he thinks, how he practices, what he preaches. And it's a great example for someone who needs to master tilt and emotional control. That being said, it's not like I have mastered that, um, but I have been able to be exposed to this sort of thinking. So the seed of what to do in such situations is planted, and I think that's what um, exposure to these particular books or articles sort of does. In the last section, which is stack the deck, um, he he says that in life you can stack the deck. He gives the examples of how moving to San Francisco for tech or New York for finance is like literally rigging the game. This also talks back to something which Warren Buffett says, which is uh, he talks about the genetic lottery, which is also what Charlie Munger talks about. And essentially, the genetic lottery is something that you're born with. So, for instance, if you're born in the United States, you already have hit that particular genetic lottery as compared to someone who was born potentially in a conflict zone or a war-torn country where that particular individual does not have access to healthcare, safety, education, which allows him to be able to benefit or have some sort of upside in that particular individual's life. Whereas if you're born in the US, you have one of the most active public capital markets, you have venture capital, you have the best university ecosystems, um, which is sort of the genetic lottery. Going back to the article, he goes on to say, once you see life as poker, not chess, you realize something. Chess has a correct answer. There's always an objectively best move. Poker doesn't. Poker is about playing your hand optimally given your bankroll, your position, and your read on the table, which also is how life is, right? Life is different for each individual. You're you're dealt your hand, which is essentially your genetic lottery. You have a bankroll, which is how much you have made, how much you're able to make. Not every individual is in the same position. Some people get handed money from their parents, some people have to build it up from the ground up. Your position, what have you achieved? What have you been able to do? Where do you wish to go? And your read on the table, which is what is your read on life and the situations that it presents. Finally, the optimal strategy for you might be terrible for me, and that's liberating, which essentially goes back to what I just said. So I guess I'm totally aligned on this particular article. Stop playing chess, searching for the right move. Start playing poker. Make the best decision you can with incomplete information. Size your bets appropriately and trust the process over enough hands. I think if there's a takeaway, it's essentially this last paragraph, which just beautifully summarizes every single thing that he's trying to say out here. In the end, life rewards those who understand the game they're actually playing.